Okay, welcome everybody to the Fourstar podcast. I'm Brian Kasal, your founder and CEO of Fourstar Wealth. I'm here with Chris Reardon. Chris, welcome.
Yeah, thanks, Brian. Good afternoon, everyone, and glad to be here.
Everybody knows Chris is our Fourstar Director of Development, master of all things portfolio. Yes, he still loves the Cleveland Indians, and he's the caretaker of his new Golden Doodle puppy, Hudson. We are very fortunate to have you on the podcast, Chris.
Yeah, thanks again, Brian.
And I'm Brian, your founder, CEO of Fourstar, Eagle Scout, trustee of the National Boy Scout Foundation, and chief dad to Evan and Quinn, husband to the amazing Tripty. Don't forget, everybody, if you like what you're hearing, give us a 5 out of 5 on the reviews. You can do that in Apple iTunes. You can give us rankings there as well. And I think you can comment in some of the other services as well, but I know Apple iTunes has the most prominent area there. But we're going to do a full podcast today with the markets, the economy, and what we see out there. But today's a special day. Here I am, I am in what I call the goat's den. The goat, Dave Gautreaux, is our host today, and he's one of the top 5 listeners of the Fourstar podcast. And we're on Diamond Lake, just outside Cassopolis, Michigan. You see that beautiful lake out there. And Diamond Lake is in southern Michigan. And we talk a lot about America. Last weekend with the GOAT, we were up in Door County, Wisconsin, the cherry capital of Wisconsin. Now we're going across the upper Midwest and southern Michigan. Later today, we're going to Toledo to see what's going on over there. So we talk about all this great stuff about the economy. Now we're going to go have a look at it. We're also 25 miles from South Bend, Indiana, for all of you podcast listeners who are into NCAA football. The University of Notre Dame and the Fighting Irish, a lot of fans of the Fighting Irish. In fact, one of the winningest NCAA coaches in history, Coach Kelly of the Fighting Irish, has a place on this lake, on Diamond Lake. So hey, Dave, why don't you come in and say hi to the podcast?
Welcome. Hello, everyone.
There's Dave. He's in uniform, too. He's got his Fourstar shirt on, which is great. And Dave, what are you here to tell our podcast listeners today?
Well, I would encourage everyone to listen to the Fourstar podcast. They cover everything from the Chicago Cubs to commodities, from the Cleveland Indians to Bitcoin. And I am trying to encourage somebody from the Antarctica to finish the Fourstar podcast list.
All the way around the world, right?
All the way around the world.
Yes. So you're volunteering to go to Antarctica too?
No.
Oh, okay. So we still. I've got a couple of volunteers, so we still need to kind of think about that one, right? Dave, thanks for being on the podcast, and thanks for being one of our best listeners.
You bet.
All right. Okay. All right. Well, there we go. A little cameo appearance for the GOAT, as we call him. So, Chris, tell me, have there been many changes since the last podcast in the markets? Let's talk about the markets.
Yeah. So, actually, it's been relatively quiet. I would say for the first time in a while. So, not too much changed really. Domestic equities is still number 1. It gained a point, which is positive. If you guys have been following along, it did weaken a little bit, not a lot, but it did weaken a little bit over the last 2 to 3 months. So we finally saw it start to gain back a point since the last podcast, 315 in the number 1 position. Commodities still holds the number 2 position, and it's been relatively steady. It's been flat. No change there. It's at 268. International equities gained 1. In the 3rd position, it's at 250. And then fixed income in 4th position equal, 113. Cash in 5th position equal at 93. And then currencies is in last, our 6th position at 50, and it lost a point. So still not a whole lot's changed kind of in the overall structure. It's still really I would say a 3-horse race with domestic equities, commodities, and international equities. What'll be interesting to see is if commodities holds on to that number 2 position, or if international equities catches back up and overtakes it. So it'll be interesting to see there. I don't foresee, with what we're seeing now, domestic equities losing the number 1 position in the near term, but things can change.
So we're still in a risk-on market. So we've got the risky asset classes in 1, 2, and 3, and the lower risk asset classes in 4, 5, and 6, right? So people are still comfortable with risk here. So everyone talks about, oh, there's too much risk, but everyone seems to be taking it.
Yeah, I mean, that's exactly correct. I mean, it's a very, very risk-on environment. And, the risk-off environment, we've talked that fixed income has been a tough place to be. Really, for the last decade, it's been a tough place to be. And cash and currency certainly just, relative to those top three risk-on asset classes, are just not performing as well.
Yeah. Well, and the story of last year, of course, everyone knows in the previous podcast was all about technology and some healthcare. Now that's all changed. We've got different sectors. So technology is still correcting, and chips are still in big shortage. Digital chips for computer chips for computers and other applications. So that area is still attractive. We did get a list in our inbox this week from the Motley Fool of their favorite names right now. So we went down the whole list, and mostly all technology, and we wouldn't touch most of them, frankly, at this point. But they're looking for the long term, I guess. But maybe a third of those names are viable here. The rest of them are still trending down. So why would you buy a stock that's going down? So we're going to watch those names and see when they finally start to recover, whether we get a momentum signal or a breakout signal or something. And then we'll see an opportunity to maybe get into some of those names. But technology will recover, but it's not right now. So.
Yeah, an interesting tidbit with NVIDIA, actually, they came out, I want to say, a couple of weeks ago. So NVIDIA makes graphics cards, if for those of you that don't know it. It's really big in Bitcoin mining. That's why they're getting like wiped out of their supplies, because everyone wants to Bitcoin mine to make all this money. So NVIDIA, you would think they'd want to take advantage of this. That's actually against their business model, because they want to make graphics cards for computers, for computer gaming, things like that. So they're actually trying to design a graphics card that cannot be used for Bitcoin mining. So they're actually going out of their way to try to so increase the supply for people that actually want to use their product for its intended use.
Yeah, so NVIDIA is one of those technology names that looks good. Amazon, there's a few others, but the rest are all kind of in a free fall. So we'll let the free fall end, and we'll wait till we get better signals for most of them. But NVIDIA is an interesting name here. But all right, so and then commodities, Chris, have been very hot. I know you've looked at a lot of them.
Yeah, I mean, the commodities, as we talked about kind of in our market recap at the beginning, have been hot. So of the areas that have been really attractive, I would say food prices, agriculture has been big, copper and tin. From the agricultural perspective, the global food prices, the UN Food and Agricultural Organization monthly index jumped 40% in May, which is the largest jump ever seen from that index. So it's large. I mean, and we're seeing that. It's a little different in the U.S., I will say. So this is mostly Europe, the continental Europe continent. But how that impact that'll have on the U.S., we'll see. I think what people are kind of looking at now is U.S. consumers and businesses might face about a 6.1% increase is what their estimate is, which is certainly going to be large. But I think the other thing that has to be factored in is these indexes and everything usually base off of year to year. So it's usually a 12-month or rolling. If you think where we were 12 months ago, things were significantly different. So I would always say take these with a grain of salt. But I think there's no doubt, especially from an agricultural perspective, in global, we're seeing things rise. Food prices are rising just in general.
Yeah.
Then
so it's more expensive to eat.
Yeah, no, it's certainly more expensive to heat. And we've talked about this on here. I think it was 2 years ago. We had China actually had it, and it's funny. We talked about it, I think, before you really heard about it in the news. But they had swine. I think it was swine flu. It devastated their kind of pig population there, and they eat a lot of pork. And so that's still having ripple effects throughout the world. So there's still a lot of other kind of other stories at play there. But the agricultural market, we're probably going to see higher food prices, at least in the near term, until things kind of restabilize back out. On top of that, you have copper and tin. We've talked about copper, I think, on this before, but we're seeing a massive, uptick in copper. I think in May it was trading at 10,000, like 10,400 roughly, which was the highest it's been in a decade, I want to say.
Mhm.
It's been stabilized back out, but it's still holding above 10,000 a ton, which is kind of the metric they use. And we don't see that changing really for the foreseeable, because you have China who's buying a lot, and that's really driving up the price. And then you really have kind of this, I would say you could call it a zeitgeist shift, but you have this shift towards electronic vehicles, environmental initiatives, things going on there. So a lot of those electronic vehicles, electronic power, environmental power and stuff like that, a lot of that uses copper wiring. It uses copper in a lot of its components. So we may have just seen really a supply and demand shift is possibly here. And so right now we may see an increase in the demand, because go back 10, 15 years ago, we didn't have the demand of electronic vehicles and the demand that we're seeing right now. So we may see this jump out for the next 5 years or so. We don't know what the length will be until supply catches back up. And once that equalizes back out, we'll probably see prices kind of start to moderate back down.
Yeah, so there's been a shortage in production and an increase in demand, which is like the double whammy to the equilibrium. So prices spike, which is what you're now. Yeah.
They definitely spiked. I mean, and I think they'll come maybe down from this high, like you said, just because of what we went through the last year and supply chain issues. But most likely they're still going to be elevated from where they were pre-pandemic, just because of some of those things that I said. A lot of it will have to do with what China's the largest consumer of copper. So really how they dictate it, if they want to continue building, it'll most likely continue going up. Exactly. And the last one I'll talk about real quick is tin. So tin actually hit an all-time decade-long high too as well. And this was mostly driven by, like Brian had mentioned, the tech play kind of that was going on all last year. So you have a lot of tin that's in, semiconductor units. You have it for soldering. A lot of these electronic components, tin is heavily utilized in them. So when you had this work from home shift, you had people kind of having to retool, buy new computers, maybe buy laptops, things like that. You had this big, spree to go buy all that stuff. So we're seeing a big jump in tin as well, which is really, playing with the commodities right now.
Yes. So a lot of changes there. The other thing that's going on in the markets now is the stay-at-home trade is over. BTRS, RIDE, FSR, these are all names that people were buying because they were helping and assisting people who are going to work at home and never go back to the office. Well, turns out a lot of people are going back to the office now. The city of Chicago is getting full again. So people are coming back, maybe not all of them yet, but the stocks that were supporting the stay-at-home trade have collapsed. The other thing that's changed just recently is the IPO mania is pretty much over. In January, there were a lot of IPOs, and they were coming out of these special purpose acquisition corps, or SPACs. And so a lot of those are underwater. Hot names like Oatly and Compass Real Estate from 20 down to 12. So a lot of these stocks are getting killed. And so now we're seeing speculation kind of unwind. It just seems like, there's always little kind of speculative ramp ups in the market. And Chris, you're going to talk a little bit about AMC, I think, later on. Bitcoin was 60,000 a unit. Now that's down to 37,000 as of today. So it's down, close to 45% from the high. So a lot of speculative things kind of fade out. So.
Yeah, no, I mean, especially Bitcoin. Bitcoin, you almost have to check it by it's funny, we were talking about it just before we tape right now. It's kind of, where's Bitcoin at now? And it's like the last you looked at it's at 34, and then you'll check it again, it's at 37. So, I mean, that's thousands of dollars. It's moving at such a rapid pace. It's pretty crazy.
So we talk a lot about bubbles and what will pop the bubble. And, people are saying, gee, we're in an accelerated market right now. There's actually, I heard there's some public officials in Europe telling people not to buy into their stock market. And, I certainly think public officials would be the last people to know whether the stock market is expensive. But, a lot of people are saying things like that. The very famous investment advisor, Jeremy Grantham, talks a lot about bubbles. And, there's all kinds of signs that maybe things are a little expensive here. But we've also put $12 trillion, and now we're trying to put more into the economy and spending. So where does that all end? We've never come close to putting this kind of money into the economy. So does that take the Dow to 50,000, or are we done here? We really don't know. I mean, it's a matter of what ends up happening with all that money, and a lot of the money gets released in later years. So if we have some money coming out in the fall, then we have money in 22, 23, no doubt about this, that a lot of the money that's been authorized by the politicians is set up to help them get reelected. So they're going to want to have money later, not money right now, all in. So they want to keep the game going for a while. So, big up moves like this could end with a whimper. Now we're in an economic recovery because we had such a collapse during the pandemic. So generally during economic recoveries, markets don't crash. They may correct, they may fade, they may stop going up or stagnate. But to have a big crash when the economy is growing, generally not something that happens. So I think the risk of having a huge 50% collapse in the next year is somewhat limited. Not impossible, but somewhat limited. But, when you look at, let's look back to Japan in the 1980s. Everyone thought Japan was going to take over the world, but their economy was fueled on heavy leverage, and they were offering 5 and 6 times leverage on properties. Well, that ended it very, very badly. Their stock market was at 30,000 on the Nikkei index, and it went back down to like 15,000. It's in the 20,000s now, 35 years later. So they've never really recovered, and that's how they dealt with their bubble. China is similar today, where they've got a bubble economy. Their markets have been strong. It's just it's interesting how things are going to play out. But now the GMO group and Jeremy Grantham is talking about what we're talking about: dividend stocks, international stocks in U.S. terms. So there are some things to buy that are cheap here. So that's what there will continue to be the shift out of high growth, high technology into other areas. So there may still be legs left for this market. But where does it all end? Well, I don't think it's going to end with a complete collapse, but it could be a whimper. We could have a sharp correction at any time. But I don't see a huge downside here. We're in an economic recovery, and I hope things continue to go well. Chris, you were talking about carbon trading as well. That's a big thing.
Yeah, and that's an interesting byproduct of a lot of this. Carbon trading, which it's kind of, I guess, a commodity. It's kind of an offshoot, if you will, of a commodity. But they've started to really kind of turn these into these investment vehicles, really. And actually, we invested in one of these investment vehicles, 4 or 5 months ago. We kind of made our foray into commodities in our dynamic allocation portfolio. But it's been, these carbon credits in the European continent, they've been up 135% in the past 12 months. I mean, obviously a lot of movement there, a lot of gain there. I think it's something that's going to continue going forward just with the way the global environment is now. But it's really interesting that we've taken this, I would say this political topic in some sense, or environmental really, but it has political aspects to it. And now we've turned it into this commodity, and you have these credits now and they sell. So, realistically, that's kind of a weird way of kind of applying American or kind of the free market idea to help change environmental impact,
Manage pollution.
If you have a lot of people polluting, a lot of people are going to want to buy those credits. And if people are buying those credits prices are going to go up. So people are going to be disincentivized to pollute. So it's kind of a funny way of doing it, but it really shows the power of, the free market and economic system. If you can kind of put certain things in place, it can correct itself really.
Absolutely. So a lot of bubbles, a lot of things are spiking upward. I'd call that inflation. Fed's trying to say it's transitory, temporary. We'll see. I'm not sure I agree with that, but we'll see if the Fed is right, or maybe they change their tune if things look a little crazier than they thought. But switching further, Chris, to the economy, most of the estimates based on economic growth say rates should be higher right now than they are. Fed funds rate, at very low levels, near zero. We're seeing the 30-year Treasury rates spike up a little bit here. We're seeing some of the 10-year rates spike upward. But again, if you can get a 3% dividend in a stock and your 10-year bond is at 1.6, what would you buy? You'd probably buy the stock, and that's why the markets continue to go up with rates low and with supporting higher multiples. So that's kind of what we're seeing. And the Fed says they need more data, and they expect that this inflation spike is temporary. Their target level of inflation is 2%. But Chris, didn't we have 4% inflation, 4.1 in April?
I think so. I think that's what
it was. Yeah, it was.
Yeah,
So,
well, because April would be it was a year, right? That was the annualized, because that was when we first kind of hit the pandemic, the downturn on the way out.
Exactly. So we're in this really difficult process right now, everybody, and it's one of these things where the Fed wants to keep interest rates low and keep liquidity in the economy to keep the economy recovering. We don't want to stagnate the economy. So we do have obviously a recovery on. They're trying to keep rates low. At the same time, to ward off inflation, they would have to raise rates, right? So if you have a stagnant economy or an economy you don't want to stagnate, and then you have an inflation environment, then, in the 1970s, they called this stagflation, right? So we're back at stagflation, where we want to keep interest rates low, but yet inflation is going up and you're paying 40% more for certain foodstuffs. So it's a little bit of a crazy time. And, some have commented that in 5 months, the Biden plan has taken us back 5 decades. And it feels like the 1970s. I was a teenager in the 1970s, Chris, and I remember there were gas lines. It didn't affect me that much, but I remember my dad having to go to the gas station and just wait forever to get gas. And I remember bus fare to scout camp doubled, so oil prices were going up. And, it seemed like a fun time when we were kids, but it wasn't fun for our parents. Mm-hmm. That's for sure. And we're seeing a lot of that right now, where basic costs of lumber and basic things are going through the roof. So that's inflation, and that's not really terribly healthy for the economy. That's being caused by all the money out there. There's helicopter money being dropped from helicopters, it feels like, almost. And so everybody's got a lot of money in their bank account. They're spending a lot of money on goods, raising prices up. We talked about real estate on previous podcasts. There's some videos out there about real estate prices. We're talking about oil prices going up. Everything's going up. So it's quite interesting.
I mean, I think that, we're in kind of a weird situation right now, I would say, where we don't know, is it transitory? People could make the case for that. Is it not transitory? You could make it either way. So I think the only thing we'll have to see is just kind of take it month by month, and, we'll see a year from now, really, right? If it's transitory, this should all kind of wash out in a year. So I think we're definitely going to have some inflation. It's definitely going to go up, but the amount, I think, is the key.
Yes. Well, and now, there's clearly identified a impediment to people going to work. So with all the extra subsidies and additional add-ons that they've done with unemployment benefits, an individual, instead of making 22 or 24,000 on unemployment, which is no real living right at the poverty level, now you can make 32,000 on unemployment. So let's say a couple, husband, wife, or two husbands or two wives, you never know these days. You've got, you can have 32,000 per person, 64,000 on unemployment for two people. And then with all the other government benefits estimated at that level to be for people who are out of work about 15 to 20,000, you're into $80,000 a year to sit on your couch and watch Netflix or trade AMC stock or whatever you do on your couch, right? So a lot of people don't want to go back to work. Although ironically, now 29 states are planning to end the enhanced unemployment benefits in July, and that'll get people off their couch and back to work. So then that 32 goes down to 24 again. And then some of the other benefits start going away. So we did a podcast a couple of weeks ago, and then one of the video clips that went out on the internet was the best stimulus program is a job. And we talked all about that and why that's true. And that's exactly true. So, Amazon is being forced to pay extra to get people to come to work. They're giving signing bonuses of $1,000 to get people off their couch and come to work. McDonald's raised their pay 10% for all the working people to come back. Some have even said, well, maybe the administration's keeping all these benefits in place and trying to keep the benefits high to force companies to pay more. And then one famous economist said, yeah, don't give the administration that much credit. So I think they're probably right. But nonetheless, we see that companies are having to pay more. Big hiring is coming. Chipotle, McDonald's, KFC, Applebee's, tens of thousands of new jobs, and indoor dining comes back. Amazon has 75,000 jobs to fill, and they're paying, as I said, those $1,000 bonuses. So government money is now coming with requirements that change policies, and they've been changing policies without congressional approval. A lot of that stuff is going to come back in line as people essentially challenge the government for not following the government rules. So things kind of went off the rails, I think, during that pandemic era, where a lot of the rules were just blasted through. All the HIPAA rules of privacy were blasted through with regard to vaccines and everything. It seems now it's like rational thought processes coming back in.
Mm-hmm. Yeah, I mean, it'll be really interesting. I mean, I think we talked about it, I think maybe the last podcast or 2 podcasts ago, where we're really seeing this tug and pull happen in the market right now. It's a tug of war where, the companies are trying to incentivize, trying to pull people back, to work or get them in the office. And, some people are saying, I'm not willing to work for that price. So, it's going to be really interesting to see. I do think the latest jobs report number came out. That was positive, a little less than the expectation, but much better than the 200,000 some odd we had in April. So seems like we're starting to get a little bit of traction. People are starting to kind of get nudged back to work, which is positive.
Yeah, that's good. Now, the Biden administration just issued its first budget suggestion that'll go through Congress for passing for the fiscal starting in October. And their budget suggestion is the largest single spending budget in American history, to spend $6 trillion, but they only have revenue of about $4 trillion. So they're adding another $2 trillion in debt. So that would be $14 trillion of new spending in the last 18 months. So Bob Barone, our Fourstar economist, in a recent piece that he issued in Forbes magazine, talks about, how money does grow on trees. And so we're doing so much spending, we're going to end up like Japan. So let's talk about what that means. So when our debt was about 7 or 8 trillion, and our economy was 18 trillion, we were at about 40 or 50% of gross domestic product in our national debt. Now our national debt is 28 trillion, and our economy's grown to about 21 trillion. So now we're at 120% of gross domestic product. We're getting to scary levels. We've adopted a strategy in America of current spending on a deficit basis. So every year, it's like there's this big pile of debt, and every year we add another trillion to it. The last couple of years, we've added 4 or 5 trillion because of the pandemic. So at some point, the pile just gets too big and starts crashing down, and that's what would happen to America. Let's fast forward to look at Japan. Japan kept adding debt when they didn't know what to do. And so now they're at 270% of gross domestic product, and their debt is unmanageable. So to manage their country, they've had to buy 25 to 30% of their own debt to keep the debt from collapsing. And then they've also nationalized industries, so they control about 35% of their own economy. So at some point, you realize that we could end up like Japan. There's no growth there. Demographically, it's in very big trouble. They can't get inflation going. There's nothing going in Japan. It's basically a zombie country. We don't want to be like that. Right now, America is the #1 economic growth engine in the world. We're also the reserve currency. So there are literally tens of trillions of dollars in bank accounts for countries and companies all around the world that uses the dollar for international trade. If we blow up our currency, we'll no longer be the reserve currency. And maybe they'll trade, as you say, Chris, a basket of other currencies. Mm-hmm. Maybe, I don't think it'll be the euro, but maybe some other currency they'll trade in. but America will no longer have the exclusive franchise as being the world trading currency, the reserve currency. So we have to be really, really careful. We could stop adding to our debt right here and not pay it off. But then as the economy grew to 30 and 40 trillion over the next decade, well, then it would be a smaller percentage, that 28 trillion, or we could start paying it down. We used to do that in America. We only reserved adding debt to wars and special circumstances and financial panics, but then we would slowly pay it down through budget surpluses. We don't do that anymore, and that's putting us at big risk. So we don't want to continue to do that. Chris, you had mentioned before about the currency disruption. There's never been a currency that's lasted over 200 years without major disruption. Mm-hmm. We're out there. We're what, 220 years worth.
Yeah.
So we're the longest standing currency that hasn't collapsed. But we're not far from that, right? So we have to be really careful.
No, yeah, I mean it's scary. I mean, I think, the easy way you look at it, if you think about the United States, as just a U.S. household, really, I mean, would it make sense for a U.S. household to have that much debt and very little income coming in comparatively? It just doesn't make sense. And, we're in the fortunate situation that we're kind of the leader right now of the world. Not many countries would really challenge us to a degree. Maybe if we were a smaller country, we might be in, bigger trouble. But, you can't continue to do that. You're kind of rolling the dice every time. And we've certainly seen China and certain countries really start to kind of assert themselves. So, it may come to head sooner rather than later, for sure.
Yeah. Well, we'll see. We're watching it closely, and we'll keep reporting on what we see. So moving to the what we see out there segment of our podcast, Chris, big tech, but a lot of discussions there. They're kind of operating like a public utility, aren't they? The big technology.
Well, yeah, I mean, I think that, it's been that's been debated in Congress and from that aspect for a while now, whether they need to be regulated, how they need to be regulated, because a lot of people look to big tech in a lot of ways for whether it's news for certain aspects. So, it's an interesting twist that's come out, in the last 10 to 15 years.
Yeah. So the big tech firms are given a monopoly, so they could, service the public without lawsuits, and that people could speak on their platform. But now they're censoring people. So there's all kinds of, the long knives are out, for technology in Congress, because the conservatives want to manage through and get rid of Section 230, which gives them that immunity, because they think that's offensive. But yet the more liberal side or the Democratic side, they're against monopolies, so they want to break up the monopoly. So as I say, the long knives are out for technology. I think over the next decade, the big technology firms change in their composition and their power. So then the other thing besides Section 230 that gives them the immunity or breaking up the monopolies, they could also certainly regulate those companies. And guess what? That's what we do with utilities. We regulate them because everybody has to use a utility. We used to always say in some industries, hey, this isn't a public utility. We don't have to work with everyone, right? Mm-hmm. Well, that's in most businesses, but a public utility does, and so does Facebook and all the other companies. But now they're, censoring people. They're using their economic power to hurt people. So none of this is a good development. So we'll see. There are going to be big changes coming there as well. So that's to be seen. Moving to cryptocurrencies, we've now seen in a very graphic way some new uses for cryptocurrencies. Chris, how about paying ransom on a pipeline?
Yeah, I mean, I think let's now with the recent pipeline, that's the biggest case we've really seen. But I wouldn't necessarily say it's new. It's definitely the most high-profile way it's been used as of late.
That's right. So cryptocurrencies are obviously growing, and now they're talking about regulating cryptocurrencies, which was kind of the opposite of the whole point of cryptocurrencies, that nobody would regulate them. And they could move around the government and didn't have to worry about the dollar being inflated and value being deflated and all that stuff. But it looks like they're going to start regulating that also. We want to talk a little bit about the pandemic, and now things are recovering and it's great. And people were wearing masks for a long time, and then there was a sense of virtue signaling about wearing a mask. Now the Centers for Disease Control have said basically if you're vaccinated and protected, you no longer have to wear a mask. But yet there are some people that felt really comfortable wearing a mask. And so back the old days, you only wore a mask if you're a bad guy. But then it became that you could now wear a mask and it makes you a good guy. And you're honoring your citizens and everyone in the neighborhood. Well, now that you don't have to wear a mask, some people are uncomfortable because they felt positive wearing a mask, and they're signaling their virtue of what a good person they are wearing a mask. CDC says you don't need it. Nancy Pelosi says, oh no, we're going to wear masks in Congress. And some companies are saying, well, we're going to wear masks. So I call it mask confusion, Chris. Wouldn't you call it that?
Yeah, mask confusion. Well, it's definitely interesting. I mean, we've definitely seen it here, Chicago. I mean, I think that it's funny. There's two major grocery store chains. I would compare this to my experience this last weekend. And I went to one of the major grocery store chains, which is Mariano's. And they have their sign up, if you're vaccinated, you do not need to wear a mask. And then at the same weekend, we went to Jewel, and there they said you need to wear a mask no matter what when you're in there, whether you're vaccinated or not. So it's really interesting how it's playing out here. I think I think it will. We're kind of in this in-between period though, and I think some companies just don't know what to do. And I think you have liability issues, you have health issues, you have legal issues. So I would say exactly like you said, mass confusion is a great way to sum it up. You hope that in the next couple months, things will get ironed out a little bit more. But in the short term, it's definitely been a little hectic to say the least.
Yes. Well, and now the big news this past couple of weeks is that theory that people were floating last year and then got canceled and shut down, and even social media was shutting people down if they ever made mention of the fact that some people think that this pandemic came from a virus that was created in the Wuhan virology lab. And some people are even speculating it was the Chinese government specifically causing it. Although now they found out that in October, they shut down all communications in Wuhan. So there was like a whole month where there was no cell phone activity, and they were basically clamping down. There were a bunch of people from that lab that went to the hospital and they were sick. So apparently that virus was breaking out in Wuhan. That's what it looks like, at least. So even though you were canceled and abused and yelled at for saying that this pandemic virus came from the Wuhan lab, looks more and more like it did actually come from the lab. And so they're now investigating that. And so a lot of folks think it has to do with the previous president, that people didn't like what he said. The political folks can discuss why. If you go on CNBC and CNN, you get one side of it. You go on Fox, OAN, and Newsmax, you get another side of it. So we're not here really to kind of settle that issue, but we're here to discuss that a China weak policy is bad for America, because China has the stated goal of trying to take control of America, and it will change business prospects dramatically. China's structure doesn't work though. China has kind of quasi-capitalism and communism, but you can't have capitalism and communism under the same structure, because capitalism requires freedom of choice, which they don't allow in communist countries. So eventually the Chinese capitalist structure will collapse and break down. But right now they're riding high and they're really strong and they're scaring a lot of people. The previous administration was very tough on China, tariff China. The Biden group says they're going to stay with those rules, but my sources are telling me that a lot of the tariffs and other rules that were put in place to be tough with China are kind of being ignored to some extent. So we'll see how it plays out. This Wuhan lab theory leak, though, regarding the pandemic virus could be a big thing if countries around the world start suing and going after China for their involvement in this. If the Chinese government knew about it, Did they know about it? When did they know about it? Did they let it out? Did they purposely let it out? Or if they knew about it, why didn't they tell us in October? Why didn't we find out until like January? Right? So there's a lot of questions there, and it could change international trade. It could change China's relationship with the whole world. So we'll see how that plays out. It'll affect business for sure. It'll affect markets for sure. So,
yeah, I mean, I think I think what needs to be done is just an independent investigation needs to occur. I think the World Health Organization did it, but you had the Communist Party in China that was blocking a lot of access, and there's some credibility issues, I think, with the World Health Organization and the funding that's been donated to it. So, I think that you just need to get to the bottom of it, and then we'll kind of see what comes from there. I do think that it's been proven that China knew about it ahead of time and did delay in getting it out. I mean, I don't think anyone would say that that's not true, because that's been pretty much a fact at this point. So, what this lends to, I think it's going to lead to possibly heightened tensions around the world, which, it could create for a scary environment. I think China's trying to assert itself, and what impact could that have, globally, could be large. It's just something we don't know as of right now, though.
I mean, the truth is, to run a capitalistic country with freedom and democracy and liberty is a hard thing to do. We've learned that in America. And so, a lot of things don't always work that perfectly. To think that the Chinese can come in and command and control, make capitalism work, allocate resources fairly to run a country like ours with command and control environment is pretty much of a stretch. So I think they're going to learn the hard way that people have an opinion, and they don't have enough military to take out all their people. So we'll see. It's going to get pretty tense over in China. On a lighter note, in the last year, no one thought golf would recover, but golf courses were being swooped up for multifamily housing complexes, and golf was in decline, and golf clubs were losing members and everything else. All of a sudden, golf's the hottest thing out there. Now there's a shortage of golf carts because they haven't made many. And if you can drive around in the neighborhood in a golf cart, we just bought one for our Michigan house. Now golf carts are in big time short supply. And a year ago, golf was dead. It's kind of an amazing situation. So, we got an email saying that after we bought our golf cart, the next golf carts, you have to wait until 2022. So we're reporting on the golf cart shortage in America.
Well, I can definitely say, for my generation especially, I think that's one of the things from the pandemic. I think, there are shifts and everything. I think that, people didn't like golf. Now we had this pandemic, people were cooped up inside in a lot of ways. It felt good to get outside, and people kind of picked up the game again and kind of got back into it. So I think there has been a resurgence of people that want to get out there and want to play. That's
right. They want to get out and golf. Now, Chris, you had a couple of things on AMC and United you were mentioning earlier.
Yeah. Well, you had mentioned a little bit earlier, AMC is kind of the latest GameStop, I guess you could say. So it got driven up 97% this week. So it's trading at, let's say, beginning of May, it was trading about $10 a share. It went up as high as, I think, 72, which is just crazy.
That's a good trade. That's a good trade, yeah.
It's a great trade, but we've seen this before. So what does AMC do? They do the smart thing that Hertz tried to do about a year ago, and they said, all right, well, we're going to go issue new stock at $72 a share. And they did. They raised about $587 million, which good for them. But in the prospectus, they had to kind of detail out for the sale with the SEC. They said in there that the stock price is not reflective of our current operations, essentially. So it's really not reflective of what they're doing. And not only that, but anyone who invests in this, it's a highly speculative asset, essentially very volatile, and you expect to lose possibly all your money.
Right.
So they pretty much came out there and said that their stock is overvalued.
We're offering you stock, but don't buy it.
There's no reflection of their current, and it's pretty crazy. Good for them. I mean, I think the company's been battered over the last year. Obviously, with pandemic, movie theaters have been one of the hardest hit. So that at least helps them a little bit, but it's crazy. The speculation is just so rampant. And then on the side note, another cool thing that's going on is United put in an order for 15 jets, and they're supersonic jets from this small company, Boom. I think it's Boom Technologies. So they're kind of trying to make a foray back. If I don't know if anyone remembers the old supersonic jets. I forget the name of the carrier. What starts with a C? I'm blanking on the carrier, but yeah, so we're seeing kind of a reflection back to supersonic, and we had that jet, but people didn't like it back then. People were like, I'd rather make that slow journey across, from the U.S. to London, and so we kind of had a reversal. Maybe we're going back to supersonic. Maybe people don't want to be in the air as long because with COVID, they didn't feel comfortable being in there with a mask and stuff. They just said, get
the mask on 8 hours across the pond
as possible, and let me be done with it. So it's interesting. It's still very early, and I believe these are smaller jets, so they're definitely going to be a little bit more maybe regional. But it'll be interesting to see if we're going to move back in that direction.
Yes, it's interesting. The human mind is an amazing thing, and we all want to have good value in things that we buy, but yet sometimes we just like to feel good about it when we buy as well. So last weekend when I was with the GOAT up in Wisconsin, we saw this new gas station called Amoco. Anybody remember that brand? Well, that was the American oil company. That was Standard Oil of Ohio, and they were the big brand, and they sold about 15 years ago, I think maybe more than that, to British Petroleum. So now all the stations had that sunburst and the BP symbol all around America. And it turns out that the oil companies realize, some of those old brands are pretty good, kind of like rolling out like old beers and old liquors. People have like an old affinity to drinking Pabst Blue Ribbon or something like that. So if you go on the website for Amoco, if you Google Amoco, they'll say, yes, the Amoco brand is back. Just like nostalgia of America back in the old days. So now there's Amoco gas stations around America, and they're right down the block from this one Amoco station up in Sister Bay, or near Sister Bay, Wisconsin, was a BP station. Of course, they're owned by the same company, but they're very different. So if you like America, you might go to the Amoco gas. It's the same gas, everybody. But marketing is we like to buy what we feel comfortable with. And some folks have seen the Sinclair dinosaur. And some folks might remember the days when they handed out little soaps, like little dinosaur soaps, and they smelled nice and everything. Anyway, that was the Sinclair brand. That was part of Atlantic Richfield Arco, which became part of Chevron. So now they're stationed again for Sinclair. So they're rolling out the old brands, and it's old Americana, and people feel good about it. So I guess the oil companies are getting into marketing, right? And you might buy more gas from Amoco because you feel better about it. So I thought that was an interesting thing to point out for our listeners in the podcast. So anyway, so I think that's all we got today, Chris. What do you think?
Yeah, no, I think that covers it. Gets us kind of caught up, right?
Yeah, well, let's leave it there. Thanks, everybody, from the shores of Diamond Lake. Here we are. Thank you to the GOAT for hosting today. On behalf of our great Fourstar team, Chris, my co-host here back in Chicago, Laura Swanson, Chris Wanneberg, our Chicago-based crew, and then our East Coast crew, Tucker, Brian, and Karen, working for Fourstar on the East Coast. We wish everybody a great first summer weekend after the after the Memorial Day weekend. Wish you a great weekend, and we'll be back soon with another podcast and some great video clips as well. Thanks, everybody.